CNBC TV 18, celebrating 16 years of business leadership.
The 7th Pay Commission has made its award. That's going to add some amount to spending.
The nominal GDP growth is lower. That is because inflation levels are low.
The government scales down its growth forecast for the fiscal to around 7% from the 8% range earlier. The mid-year economic review also admits that the FY17 fiscal deficit target of 3.5% is challenging.
We told you first that it's now official. GST hits a dead end in this winter session. No consensus between the government and the Congress party, but we do have a truce in Parliament as opposition agrees to allow the Rajya Sabha to function from Monday.
The US visa just got more expensive for IT companies. The Congress passes a bill to double the special fee on visas. Industry body NASSCOM slams the move as discriminatory and irrational.
There's simply no stopping the fall in crude oil prices. NYMEX flirts with the $35 mark as prices hover near 11-year lows. Brent set for the third straight year of losses, and that's for the first time since the 1980s.
The Fed rally fizzles on Dalal Street. Bears are back with a bang as the Sensex sheds nearly 300 points. The Nifty tumbles below 7,800.
Stung by the Delhi diesel ban, M&M unveils its first petrol micro SUV, also looks at rolling out the petrol variant of the XUV 500 and the Scorpio. The juvenile convict in the Jyoti Singh case is free to walk out, but with riders. The Delhi High Court instructs a management committee to monitor him for 2 years and see if he is fit to re-enter society. Sonia Gandhi refuses to comment on whether she will apply for bail as she and Rahul Gandhi prepare for their court appearance tomorrow in the National Herald case. Congress plans a massive show of strength, even as Subramanian Swamy sharpens his attack. The Vatican recognizes Mother Teresa's second miracle of healing. A Brazilian man with brain tumors will be made a saint of the Roman Catholic Church.
Football is not for the whole life. I want other things. Hotels, which is the biggest business that I have, and it's something that I don't have experience. And to do it with him, for me, it's fantastic because it's, as I said before, it's the number one, and I'm the number one in football, so you have everything. I respect not just the English people, but the people who love me.
Well, the self-proclaimed best footballer in the world is turning towards entrepreneurship. Cristiano Ronaldo is now hotelier. An exclusive interview coming up with him in just a bit. Good evening. Thanks very much for joining us on India Business Hour. Nantara, Messi or Ronaldo?
Ronaldo for his looks, Messi as a footballer.
All right. More on that in just a bit. But let's start with the action on Dalal Street. The Yellen rally has fizzled out. The Bears in control today as the markets lost almost all the gains that they made yesterday. So today, the Sensex lost about 280 points. It's moved further away from 26,000. The Nifty tumbled below the 7,800 mark, losing about 1%. The mid-caps did show some resilience as the mid-cap index closed with marginal losses. But for the week, the markets have actually closed higher. It's down by about 1% or so for today. But the free fall continues for crude. The global supply glut and the Fed rate hike has built more pressure on crude prices. Industry watchdog International Agency predicts global oil demand will reach 95.3 million barrels in 2015, while total supply will hit 96.9 million barrels. Look at NYMEX, 35. It's just about moved back into positive territory, and Brent at 36.89.
And the falling oil prices, Shireen, are having a negative impact on Wall Street as well as the European markets. Let's talk about Wall Street first. Major indices are seeing sharp cuts. The S&P, Dow and the NASDAQ are closing almost 1% in the red.
Well, that's the action there as far as the U.S. market is concerned. All the indices trading with a red taken down by about 1% or so. But this is the big breaking story, and a story that CNBC TV 18 has been on top of. The U.S. Congress just a short while ago has delivered a body blow to Indian IT companies. As we said, we were the first to report this story. The House has passed a spending bill which doubles the special visa fee levied on Indian IT firms. So for an H-1B visa, companies will now have to shell out $4,000, and for an L-1 visa, the fee is $4,500. This will significantly impact Indian IT companies and has left industry body NASSCOM fuming. NASSCOM President R. Chandrasekhar hit out at the move, calling it discriminatory and irrational. I spoke to him just a short while ago, and he said the Indian government needs to respond, and needs to respond very strongly.
It is really distressing that this has happened, ignoring even the Prime Minister's request. And at a time when the attempts are being made to build the bilateral trade to $500 billion from the current levels within the next 3-4 years by 2020, at a time when there is significant business in India that is being opened up to U.S. companies, at a time when I think there has been collaboration on different areas, like on the climate negotiations, etc. I think at that time that the U.S. has dealt with these, representations and these points that have been put across from India, and that they have just been brushed aside so lightly, I think that is certainly something which is a cause for very deep concern, not only for the industry, but I believe for the country as well.
You're right that this is a matter of concern for the two partners, but are you also disappointed with the way that India and the Indian government has handled this, Mr. Chandrasekhar? Because let's be clear, we haven't really seen too much fuss being made about this issue from a government point of view.
Yes, I definitely think that that this is a matter which should have been taken up strongly by the government. But I think given the fact that the Commerce Minister had taken it up with her counterpart, the U.S. Commerce Secretary, and given the fact that the Prime Minister himself had spoken to the U.S. President on this issue. Now, these are not, the kind of things which are routinely taken up at that level. So I think that it would perhaps not be fair or entirely accurate to say that these issues have not been taken up by the government and have not been taken up strongly. But I think the fact that even though it was taken up at that level, even though it has been taken up at that level, those interventions have been brushed aside. That is, I think, even more, I would say, a matter of concern.
As the president of NASSCOM, hoping the Indian government will continue to press upon the U.S. government as far as this visa issue goes. We are the macroeconomy. India's dreams of an 8% GDP will not be realized this fiscal. The government scaled down its ambitious and pretty much in line with RBI and others for FY16. Here are the key highlights from the economic review, the mid-year economic review. The growth forecast has been slashed to 77.5% from the February estimate of over 8%. The fiscal deficit target for the year remains intact at 3.9%, but the centre has admitted achieving the 3.5% target in FY17 will be challenging thanks to the 7th Pay Commission and the one rank, one pension scheme.
On the fiscal side, I think these challenges are going to be also particularly strong. We know that the 7th Pay Commission has made its award. That's going to add some amount to spending, about 0.5, 0.6, 0.65. There are many numbers depending upon the timing of implementation. There's OROP and the pension obligations.
Confident that the 3.9% fiscal deficit target that we have set for this financial year is a number that we will be able to reach. And then, of course, we've said next year will be 3.5%. So those numbers have been discussed many times, and we are sticking to that.
The nominal GDP growth is lower. That is because inflation levels are low. You see, there are always two sides to every story. Every success story also has its, difficult side. There are two sides of the coin. So when the economy, the real GDP growth is 7 and 7.5%. In the earlier years, inflation used to be very high. So therefore, the nominal GDP growth was higher. Right. And therefore, the fiscal deficit target as a percentage of the overall GDP was much higher. Right. Today, the inflation being low, naturally, the nominal GDP growth has come down significantly.
Well, government there reacting to the mid-year economic review. Now joining us to discuss the economic report is Taimur Baig, the Chief Asia Economist at Deutsche Bank, and also Rathin Roy, member of the 7th Pay Commission and the Director at the National Institute of Public Finance and Policy, or NIPFP. Gentlemen, appreciate you joining us. Taimur Baig, let me start by asking you. The Chief Economic Advisor said that the FY17 fiscal deficit target will be challenging. Do you think the review was making a case to renege on the 3.5% deficit target of next year?
I think there's a chance that they will. The underlying indicators are not particularly conducive toward achieving a sub 4% of GDP fiscal deficit, unless there is some significant cutback on fiscal spending, which is something I think this government is not committed towards. They feel that that is the only major impulse that the economy can receive support at this juncture. Therefore, in the presence of weak disinvestment revenue, in the presence of weak income tax revenue, there is a decent case to be made that the deficit should not be so sacrosanct, and then allowing it to go above 4% for this year, and perhaps not toward 3.5%, but a little higher next year is a reasonable thing to do. I think the key issue here is how the government communicates it, and the way they did it in the media review today, I think was a good start.
All right, so you're saying the deficit may not necessarily have to be sacrosanct, but God forbid what the rating agencies are going to do if we renege on that promise. But Rathin Roy, let me ask you and take that conversation forward as far as the fiscal challenges are concerned. The Chief Economic Advisor in the mid-year review has now slashed the growth forecast from 8 to 8.5% to 7 to 7.5%. Nominal GDP has declined. While there is tax buoyancy as far as indirect tax collections are concerned, disinvestment, direct tax collections continue to fall lower than what the budget estimate was. In that context then, do you believe that we are likely to see a fiscal slippage?
There is absolutely no reason for us not to meet the fiscal deficit target of 3.5% next year, as long as the growth projections for next year are met and the inflation target is met. That would mean effectively a real growth rate of around 7.5 to 8%. I'm talking about next year. And with an inflation target of 4%, that would give us a nominal growth rate of 12%.
But do you believe that that is going to be achievable given what we are seeing in the domestic situation at this point in time?
So without any incremental tax buoyancy and with current public expenditure parameters being maintained, it's a doable task.
Okay, you're saying that it is a doable task, but Taimur Baig, let me come to you. Is your base case that neither this year's 3.9% nor next year's 3.5% deficit target are likely to be met?
Yes, I think that the chance of the deficit not resting at 3.9 is fairly high. You can always do some window dressing, as we've seen in previous years, to achieve the arithmetic target. But I think we will all know on a substantive basis that what they were thinking about coming into this fiscal year and then what they will achieve at the end would be different. But there, I think one important point needs to be made that, because India treats privatization above the line, we tend to overestimate the fiscal stance to some extent. Once you take that one-off away, the current budget year, the fiscal stance was actually slightly stimulatory. Even if they go above 4% of GDP, they might end up with a slightly contractionary fiscal stance. We need to keep that in mind.
Okay, but Rathin Roy, let me ask you this, because the Chief Economic Advisor said that given the fact that you actually have the base rate higher than the nominal GDP at this point in time, that we may need to reassess both our fiscal policy as well as our monetary policy. Is that an indication or a signal asking for aggressive rate cuts from the Reserve Bank?
Well, from a monetary perspective, I think the most important thing to do is what the governor has been trying to do, which is to try and make sure that reductions in interest rates are passed on substantially, if not in full measure. If we are actually able to do that, and we are able to see, let's say by the end of next year, a 200 basis point cut in interest rates being passed on, then that is the maximum amount of monetary policy action you can take to stimulate demand. On the fiscal side, I'm afraid the government has left very little option, because the revenue deficit, notwithstanding what the chief economic advisor said, continues to be the driving force behind the overall fiscal deficit. The reason the government borrows continues to be principally to consume, and their medium-term roadmap does not show any significant change in that ratio. That being the case, in a sense, the government's fiscal deficit is already stimulating demand, and unfortunately, in that context, if the government intends to expand the fiscal deficit, it can only do so by increasing public investment but maintaining consumption expenditure.
But Rapin Roy, the Minister of State for Finance, Jayant Sinha, speaking to us, said that fiscal stimulus or stimulus of some sort will need to be provided, especially to the multiplier sectors. What will that mean then?
So in a nutshell, what I'm saying, I suppose, is that I do not see any argument for relaxing fiscal consolidation on the plea that the demand side needs to be stimulated.
Oh. Okay, so you don't see any reason or an argument for relaxing the fiscal consolidation roadmap that we have. But let me ask you this, what would be the key risks at this point in time as you see them? Because we've got the domestic factors, we've got the global factors playing out as well. And inflation at 6% is what the report is suggesting at this point in time. So what can we see as the judicious mix between fiscal as well as monetary policy action?
I would need to question the analytical premise underlying that statement, and I cannot do that unless I see the argument in the report. However, it stands to reason that if inflation is contained at around 4%, then there is definitely room for interest rate reductions. But these interest rate reductions would need to be passed on and would need to be an important driver in stimulating investment demand. If investment demand is not being stimulated because the underlying economic conditions or institutional conditions or doing business conditions are not favorable, then as the Minister of State said, that will also need to be a major focus for such a stimulus to happen. That, in my view, the Minister of State is correct. I think the major reason why investment demand is muted is, apart from the global environment, is the sort of pause with bated breath to see a perceptible improvement in the ease of doing business and governance reforms. Those have begun to happen. And if those kick in next year, then I think that will be the primary focus for increasing investment demand. I think there's fairly limited room for fiscal policy to be used to do so.
All right, Rathin Roy, Taimur Beg, appreciate you joining us with your take on the mid-year economic review. In fact, news just coming in, flashing on your screens. This is according to Finance Ministry sources. It is too early to say if the fiscal roadmap will be relaxed or not, but there are suggestions that are coming to the government. One camp seems to believe that we should relax the fiscal deficit roadmap and the fiscal deficit target should in fact be pushed to well beyond 4%. Sapna joins us now with the details. Sapna, people were reading between the lines of what the Chief Economic Advisor had to say as perhaps the government indicating that there could be a slippage from the 3.5% number that's been outlined for next year. What are you being told by your sources?
Well, the view across senior finance ministry officials in the ministry, is on two accounts. A, they're pretty categorical on the fact that it's unlikely that any big slippage is on the cards in terms of the fiscal numbers. Even if there could be a revision, the number is not going to too much. It's 3.6% as of now in the FRBM roadmap, which the finance minister has put out in the parliament. That's one. The second aspect, which is pretty clear, is that it's a bit early to take a call as of now. The budget exercise is still on. In fact, the budget, the B numbers for next financial year have not even been finalized. This will only happen sometime in the month of January. So it's a bit early to say anything much. I'm basically take a full call on this and go with the CA's a suggestion that there could be a requirement of a reassessment. Having said that, they're also keeping a close watch on the manufacturing numbers. If the manufacturing growth rate doesn't really pick up towards the last quarter of the financial, it could be a call to be taken by the government. More important, in fact, the key takeaway here is that any kind of a move forward or a slippage or a relaxation of the fiscal roadmap will have to be a larger political decision. This is very, very important. The call will have to be taken at the Prime Minister's level. It's not going to be an easy task for the government to keep changing the fiscal numbers. That's the macro signal that is emanating from Finance Ministry as of now. On the lesser side, of course, various suggestions are coming in from economists talking about tightening of the fiscal roadmap or probably even a relaxation, at the other extreme of 4.5%. But this is something that the government is not going to take very easily, in contrast to what they did last year when the 14th Finance Commission recommendations came out. This is the signal as of now.
And there are many fiscal challenges facing the government at this point in time, but there are also growth challenges. And we heard the Minister of State for Finance several times saying that we need to look at providing stimulus. Now, what exactly does that mean? And will that mean a fiscal slippage? Because then he went on to say that, no, we will achieve the 3.5% fiscal deficit target for next year. But also, look at what's happened. Growth at this point in time is being buoyed by public expenditure and private consumption. Industry at this point in time is not even picking up credit. So that is a challenge that's staring the government in the face. But appreciate you joining us with that story, Sapna.